Hello everyone, welcome to today's video. On today's video, I'll discuss a very important and a very interesting topic, which is the relation between GDP and inflation. I'll talk about how governments and central banks try to maintain the delicate balance between inflation and growth of an economy. I'll also discuss what does the RBI governor mean when he says that RBI is maintaining an accommodative monetary stance. I'll discuss all these technical jargons on this video, so stay tuned till the very end because this video will help you understand what is happening in the Indian economy. Just a quick introduction about myself. I am Ayushi. I am an Indian Economic Service Officer and I'm currently working with the Government of India. I have worked in the domains of economics, finance, and public policy for the last 7 years. On this YouTube channel, I have been making videos around various economic concepts that all of us should know because these concepts impact our daily lives. If you have been liking my content, then do press the like button and subscribe to the channel because I'll be posting content around economics, public policy, and I'll also be posting case studies on different economies of the world. So let's start today's video. The first concept is around GDP. What is GDP? GDP is the total value of all goods and services that are produced in a country in a specific time period. I have made a separate video on GDP and discussed how is it calculated, what does it indicate, and whether it is a true measure about the economic well-being of a nation on a separate video. Do watch that video. I have linked it on the top. This will give you a broad understanding about what GDP is and what it means for an economy. So GDP is basically the economic barometer of a nation. It measures how well is the nation performing in economic terms. If the GDP of a country is high, it is perceived to be good for the economy. If the GDP is low, then it is perceived to be bad for the economy. As more and more goods are produced in the economy, the GDP of that country increases. Usually, it is seen that as demand increases, producers are incentivized to produce more goods and services. They increase the production of goods and services, and hence the GDP of that economy also rises. Now, in order to increase the GDP of a country, governments and central banks of that country also resort to certain policy measures, such as fiscal policy and monetary policy. I have discussed these two terms also on a separate video and you can watch it. I've linked it on the top. But just to give you a brief overview of what fiscal policy and monetary policy are, when the government increases expenditure or reduces taxes to improve the purchasing power of the people, it is termed as fiscal policy. For example, the government could decide to construct schools and hospitals. When it constructs these buildings, it is going to employ more people. As it employs more people, it is going to increase the income of the people. When there is more income in the hands of the people have more demand, they start demanding more goods and services, and producers, in order to cater to that demand, start supplying more goods and services. This means that the overall GDP of the country increases. This is very, very broadly what fiscal policy is all about. Monetary policy is something which the central bank of a country uses in order to change the money supply in the economy or change the money that people have in their hands. For example, if the RBI, the Reserve Bank of India, changes the repo rate, it reduces the repo rate, then that leads to a lowering of interest rate. Now, lowering of interest rate means that corporates can borrow more because they have lesser interest payments to make. Similarly, retail consumers, people like you and I, we can borrow more in order to fulfill more of our demands and hence we also start borrowing more. Lower interest rate can lead to more demand and again suppliers or producers would be incentivized to produce more goods and services and hence the overall GDP of the country would rise. This in very brief is how governments and central banks affect the changes in GDP by fiscal policy and by monetary policy. Now let's come to the second term that we are going to discuss today, that is inflation. In very, very simple terms, inflation is nothing but price rise. We see it all around us. We have been observing it over the years. Prices of goods and services that we consume on a daily basis has risen over the years and this is what inflation is. Now, inflation could be because of two reasons. First could be because of demand factors. For example, if there is a sudden increase in demand, let's say that all of us collectively start consuming more carrots because of health benefits, because there is a study which says that carrots can increase your age expectancy and so on and so forth. Let's say that collectively we all start consuming more carrots. Do you think that this increased demand could be matched with the supply? Farmers would not be able to cater to this excess demand immediately. They would need to procure more raw material, they would need to improve the output per hectare that they're producing, And this means that there would be excess demand, which will not meet the supply being produced. Because of excess demand, the prices of those goods will start rising and inflation would happen. The other reason could be because of supply factors. For example, if there is an increase in the cost of raw materials such as seeds or fertilizers, or if there is an increase in the logistics cost, or if there is an increase in the wages, then again the producers would increase the prices of the goods and services that they are producing. And as consumers, we will have to pay that additional price, and this will also be termed as inflation. Now, the important thing to consider here is what is the relation between GDP and inflation in an economy. The higher the GDP, the more are the goods and services being produced in the economy. This means that factories and producers are employing more people. And if they are employing more people, then people who are being employed have more income in their hands, they have purchasing power. This can also mean that they also are demanding more. This can lead to a situation where the demand is increasing. However, the supply of goods and services is not able to meet the increasing demand. And this can lead to a situation of inflation. So, as GDP grows, usually there is seen to be a situation of inflation. GDP is accompanied by inflation. Now, this is not a foolproof thing. There may be certain circumstances wherein the GDP is not growing, but the inflation is very high, and there could be multiple permutations and combinations here. But broadly speaking, ceteris paribus, that is keeping all the assumptions in place, higher GDP is accompanied by an inflation also. I'll be discussing all these permutations and combinations on my subsequent videos, so please do subscribe to the channel if you haven't already. Now think of a situation in which the inflation continuously persists. This means that the prices are continuously rising. If the income of the people is not rising at the same level as the inflation, then the purchasing power of the people would fall, and hence they would start demanding lesser and lesser goods. This means that factories and producers would not have any incentive to produce more goods and services. They would also cut down on the production, and hence the GDP of that country will start falling. Thus, GDP and inflation are closely interlinked in any economy, and hence governments and central banks have to be very, very cautious of how GDP and inflation are balanced in that economy. Let's take the recent example of the pandemic, which hit India in March 2020. During the first lockdown, there was a sudden fall in the demand. Consumers were not demanding anything except for essential goods. They had cut down on their spending drastically, which meant that the producers and the factories, they did not have any incentive to supply more goods and services. Also, they were also hit by the pandemic, and hence they were not able to meet even their operating costs. A lot of startups and MSMEs suffered during that time, and hence in such a situation the government and the RBI intervened. How did they intervene? For example, the government introduced various schemes which put money into the hands of the people. It introduced various other schemes in order to boost the demand of the consumers. Similarly, RBI reduced the interest rates in order to incentivize companies and the private sector to borrow more and produce more, and to incentivize households like you and I in order to borrow more and start increasing their demand. These fiscal policy measures and monetary policy measures meant that there was a lot of liquidity in the economy, there was a lot of money flowing, there was a lot of cash in the hands of the people. And when the cash in the hands of the people exceeds the supply of the goods and services, it leads to a situation of inflation. When too much money is chasing very few goods and services, it leads to a situation of inflation, and this is what happened across the globe. A lot of countries introduced various fiscal and monetary policy measures in order to boost the demand and supply in the economy and improve the GDP of the countries again. However, this led to a situation in which a lot of countries saw a very, very high inflation. For example, in Europe and in US, even in India, where the inflation is currently standing at around 5.7% and is expected to increase over the coming quarters. Now, let us come to what the RBI said on 10th of February 2022, when it said that the RBI is going to stick to the accommodative monetary stance, which it has been adopting for the last few quarters. I discussed in a previous video that RBI has a monetary policy committee which has set an inflation target of 4% for the economy, plus minus 2%. That is, the broad range is 2 to 6%, with the midline target inflation at 4%. This is what the RBI targets in India. On 10th of February, the RBI said that it is going to stick to an accommodative monetary stance. This means that the government will try to keep the interest rates at a lower level in order to boost the GDP of the country. It is going to keep the repo rate at 4%. There has been no change in the repo rate for the last several quarters. And the short term target of the RBI is to improve the GDP of the country. While in India, the RBI is currently targeting the GDP of the country and is trying to improve the GDP of the country, it has not increased the interest rates in order to reduce the inflation. A lot of countries across the world have started targeting inflation. They are very bothered about the high inflation that is there in their economies. And hence, they have started increasing their interest rates in order to reduce the money supply in the economy and curb down the inflation. This is what is happening across developed countries like the US, the European Central Bank, the Bank of England, and so on and so forth. Developing countries like Brazil have also introduced rate hikes in order to curb down inflation. The question now here is, why is the RBI not trying to reduce inflation, especially when there are expectations of inflation happening and persisting in the future as well? The rationale given by RBI is that a lot of sectors in the economy have still not recovered from the pandemic. They have still not reached the pre pandemic levels, and hence it is important to support them. And hence, they have not introduced any changes in the repo rate or the interest rate. But there are a lot of critics to this policy as well. The critics are saying that the RBI has underestimated the inflationary expectations in the coming months. According to them, a loose monetary policy or introducing any liquidity in the economy further or introducing any money in the economy further can lead to a situation of very high inflation in the coming months. This is what the critics are saying. Tell me in the comments, what are your views on the current stance of RBI? Should the RBI have reduced the repo rate, or is it okay the way it is? In conclusion, the GDP and inflation in a country are very closely interlinked. In fact, they are a double edged sword. A higher GDP means that more and more goods are being produced in the economy. This means that there is a higher demand, people have purchasing power, and if there is excess demand in the economy which is not met by adequate supply of goods and services, it can lead to a situation of inflation. But to tackle inflation, the government and the RBI or the central bank of any country have to introduce fiscal policy and monetary policy. For instance, the central bank has to increase the interest rate in order to reduce the money in the hands of the people. This can lead to a situation of lowering of demand. If the demand lowers, the firms and the producers are not incentivized to produce more goods and services. They will cut down on the production, and this would mean a decrease in the GDP. So, GDP and inflation go hand in hand. There is a very delicate balance that the governments and the central banks have to maintain in order to reach the optimum point in this delicate balance. I hope with this video you could understand the linkage between GDP and inflation in an economy, and what does the RBI mean when it says that it is going to stick to its accommodative monetary stance. What is it targeting? What the other countries across the world are doing? Do comment in the comment box down below with your views on what the monetary policy of the country should be. I would be happy to discuss this further. I hope that you like the video. In case you like the video, then do press the like button and do subscribe to the channel, because I'll be posting more concepts around economics and finance and public policy in the future. With this, I'll take your leave. Till then, take care, stay safe, and bye.